Welcome back, everyone, for another deep dive. This time we're going to be taking a look at something that's been causing quite a stir in the financial world lately, and that is PennantPark Floating Rate Capital, or PFLT, which, as you know, is a company that has a dividend yield that is
huge,
well north of 11%.
Yes.
Which is
very unusual.
Pretty eye-catching, to say the least, but
it is.
There is a twist.
Oh, yeah.
The stock price has actually been dropping lately.
Yeah.
So we're going to figure out what is going on here. And to do that, we're going to be using this Motley Fool article that you've been kind enough to share with me.
It certainly has investors scratching their heads. I mean, on the surface, you would think a high dividend yield would attract buyers.
Right.
And push the price up. And clearly something else is at play here.
Okay, so before we get into that, something else, let's make sure everyone is on the same page about what PFLT actually does.
Sure.
They are what is called a business development company, or a BDC for short.
Right.
Which I'll admit can sound a little bit
Intimidating.
Yes. So how would you explain that to someone who maybe hasn't encountered that term before?
Well, think of a BDC like a specialized bank for mid-sized companies.
Okay.
These are businesses that might not be big enough to get loans from major banks.
Yeah.
But still need capital to grow.
Oh, yeah, that middle ground.
Exactly.
Okay, so they're lending money to these companies.
That's right.
But the Motley Fool article really emphasizes that PFLT is very much focused on
first lien loans.
These first lien loans. What is the significance of that?
Well, it all comes down to risk.
Okay.
A first lien loan means that if the borrower can't pay back their debt, PFLT is first in line to get whatever assets are left.
Okay, so they get first dibs, so to speak.
Yeah, exactly. It's a way to minimize their losses.
Smart.
In fact, the article mentions that as of September 30th, almost $1.75 billion out of their nearly $2 billion portfolio was in these first lien loans. That's a pretty clear signal about their risk appetite.
Yeah, they're being
conservative.
They're being cautious. You would think that investors would appreciate that, but yet we have this stock price.
We do?
Dip.
Yeah.
The article seems to tie that to their recent Q4 2024
earnings report.
Oh,
yeah.
But even that seems confusing to me because their total investment income
went up. Exceeding expectations.
Yeah. So
right.
More money coming in.
The key here is to understand the difference between total investment income and net investment income.
Okay.
The first one is essentially revenue, all the money coming in.
Okay.
But net investment income is the profit, what's left after you subtract expenses. And that figure actually went down for PFLT, missing analyst forecasts.
So they're making more money overall,
right?
But their costs are rising.
Even faster,
leading to
lower
profits, yeah.
And that spooked investors.
Yeah. I mean, that makes sense. The market tends to react pretty strongly.
It goes.
To anything that even hints at, like, shrink.
Profit margins,
yeah.
Even if other aspects of the business are doing well.
Right.
And to add to the uncertainty, PFLT didn't provide a lot of detail about what's driving these higher expenses.
Okay, so there's like this lack of transparency, and that's what's making people nervous.
Exactly.
So the Motley Fool is stepping in with their own theory as to what might be happening.
That's right.
And they're speculating that the increased size of PFLT's portfolio might be boosting revenue, but things like higher interest payments on their own debt combined with a slight drop in the average yield they're getting on those loans could be squeezing their profits.
That's their take on it. And it's worth noting that the average yield decrease could be a sign of growing competition in the lending market.
Oh, interesting.
Potentially forcing PFLT to lower their rates to attract borrowers.
Okay, so not exactly a rosy picture so far.
Not necessarily.
But before we get too gloomy, the earnings report did have one bright spot.
It did.
The number of businesses borrowing from PFLT jumped by 21% year over year.
Yep.
More customers is usually a good thing, right?
It can be, but it depends on the quality of those customers.
Right, of course.
However, the article points out that only 2 out of the 158 businesses in PFLT's portfolio are currently considered non-accrual.
Okay.
In simpler terms, that means only 2 borrowers are having serious trouble making their payments.
So they seem to be pretty good at picking
solid borrowers,
which is really
crucial,
especially.
Yeah, especially if the economy takes a downturn.
Yeah, no one knows what the future holds.
Nobody knows.
So it's good to be
prepared.
Prepared.
Yeah.
Okay, so how does this all connect back to that impressive 11.2% dividend yield that we were talking about?
Right.
Is that even sustainable if their profits are under pressure?
Well, that's the million-dollar question, isn't it? The Motley Fool article argues that this recent stock drop might be an overreaction.
Okay.
And they point to PFLT's dividend history as evidence it's not just a one-time bonus.
Mm-hmm.
They've been consistently paying out at this high rate.
Right.
And they do it monthly, not quarterly or annually like many companies.
Which is unusual.
It is.
And to be fair, BDCs, when managed well, are designed to generate this kind of steady income.
Right, correct.
For investors, they're filling a vital need in the economy.
Yeah.
By providing capital to companies that traditional banks
Often overlook.
Yeah. So they're doing something important.
They are.
And the Motley Fool article makes a case that PFLT
is an example of a well-managed BDC.
Is a well-managed BDC. Okay, so we have this apparent disconnect between a stock price that's going down and a dividend yield that's staying high.
Yeah.
Are investors missing something? Or are there deeper risks that the market is picking up on that maybe we are not seeing?
That's a great question.
We're going to dig into that and more when we come back after a quick break.
So we've been focusing a lot on the numbers.
Yeah.
Let's maybe step back for a second.
Yeah.
And think about the bigger picture here.
Okay.
What is the overall significance of BDCs, right? PFLT, in the economy as a whole?
Well, they play a crucial role, actually. You have large corporations that can access funding from big banks.
Right.
And then you have very small startups that might rely on venture capital. But in the middle, you have this huge segment of mid-sized businesses.
Yeah, the ones that are kind of in between.
That's right. And they often fall through the cracks.
Yeah, they don't fit neatly into either category.
Exactly.
Okay.
BDCs like PFLT are designed to serve those companies, providing the capital they need to expand, to hire, to innovate.
So it's not just about profits for investors.
Right.
It's about supporting businesses that might otherwise struggle.
That's to get the funding they need to grow.
When a BDC is successful, it can create a ripple effect throughout the economy.
Interesting.
Benefiting not just the investors, but also the businesses they lend to and the communities those businesses operate in.
Okay, so there's like a broader impact.
A broader impact, exactly.
Okay, that puts things into perspective a little bit more. Now, going back to PFLT specifically, the Motley Fool article does acknowledge that there are some potential risks.
Yeah, there are always risks
to consider.
Of course.
One thing they highlight is PFLT's rising interest expenses.
That's a key point.
Okay.
It's a double-edged sword for BDCs in a rising interest rate environment.
Ah, how so?
On the one hand, their loans are often structured with floating rates, meaning the interest they charge borrowers goes up as overall rates rise.
Okay, so that's good for...
They could be good for
revenue.
Yeah.
So they're making more money on the loans they've already given out.
But on the flip side, the interest PFLT pays on its own debt also goes up. And that's what the article is flagging. Those increasing borrowing costs are cutting into their profits, even as the revenue might be increasing.
It's like trying to run up an escalator that's moving down.
That's a good analogy.
You might be putting in the effort.
Right.
But it's hard to make progress.
Yeah. You're fighting against the current, so to speak.
Exactly.
And it highlights why investors are paying close attention to those profit margins.
Yeah.
If PFLT's borrowing costs keep rising faster than their income, it could put their dividend at risk, even if they're good at choosing reliable borrowers.
Okay, so how do we assess that risk? What are the key things to watch?
Well, one thing the article mentions is the average yield PFLT is getting on its debt investments.
Okay.
That figure has actually declined slightly recently.
Does that mean they're having to offer lower interest rates to attract borrowers?
It could be a sign of that.
Okay.
It might mean there's more competition in the market and other lenders are offering more attractive terms. If that trend continues, it could put further downward pressure on PFLT's profit margins.
Okay, so we have rising borrowing costs for PFLT, potentially declining yields on their loans.
Right.
But on the plus side, we have their very low rate of non-accrual loans,
right,
indicating that they're pretty good.
Strong credit underwriting.
You get underwriting.
Yeah.
So how does the Motley Fool article ultimately weigh these competing factors?
Well, they seem to believe that the market's reaction to PFLT's recent performance is a bit too pessimistic.
Okay.
They point to PFLT's track record. They successfully navigated the last interest rate hike cycle without cutting their dividend.
So they've been through this before.
They have experience dealing with this kind of challenge.
Okay.
And they believe that PFLT's management team has a strong understanding of risk and a proven ability to make adjustments as needed.
Okay.
The article also highlights PFLT's focus on those first leave loans,
Right.
suggesting that even if some borrowers do run into trouble, PFLT is well positioned to recover a significant portion of their investment.
That does sound reassuring, but I'm still a little bit wary of that shrinking profit margin.
Yeah.
Like, it's easy for a company to say, we'll maintain our dividend, but it's ultimately paid out of profits.
It is.
And if those profits keep declining, some's got to give, right?
That's a valid concern, and it's why it's so important to do your own due diligence.
Okay.
Don't just take the Motley Fool's word for it.
Right.
Look at PFLT's financial statements, their debt structure, their management team's history.
Really? Do your homework.
Exactly. Informed investing is all about asking the right questions and being willing to do the research.
This has been a really helpful breakdown.
Glad to hear it.
We've covered a lot of ground, from understanding what a BDC is and how it fits into the economy to analyzing PFLT's recent performance, the potential risks and rewards, and even the importance of considering your own investment goals.
That's crucial.
It is, yeah.
It's a personal journey.
But before we wrap up, there's one more piece of the puzzle that I want to make sure we address. And that is the Motley Fool article's theory about why the market might be undervaluing PFLT.
Right, so they think there's an opportunity here.
They seem to,
They seem to think that investors are missing something.
So what is it?
We'll dive into that next.
So what is it that investors are missing?
Okay, so they point to a few key factors.
Okay.
First, they highlight PFLT's experience.
Okay.
This isn't the first time interest rates have risen.
Right.
And in the last rate hike cycle, PFLT managed to maintain its dividend payout without issue.
So they've been there, done that.
Exactly. Their track record suggests they know how to navigate these kinds of economic shifts.
Okay.
And they believe that PFLT's management team is being proactive.
Okay.
The article mentions that PFLT has been adjusting its portfolio, focusing on loans with stronger covenants and higher credit quality. Essentially, they're trying to mitigate the risks associated with rising rates and potential economic volatility.
So they're not just sitting back and...
No, they're not just hoping for the best. They're taking concrete steps to protect their investments.
But even with those adjustments, how can they be so confident about keeping that dividend intact?
Right.
If their profits are shrinking?
Well, the article suggests that PFLT has a few levers they can pull.
Okay.
One is their ability to adjust their dividend policy.
Okay.
Remember, they currently pay out monthly.
Right, which is unusual.
Which is more frequent than most companies.
Yeah.
They could potentially switch to a quarterly payout.
Okay.
Which would give them more flexibility to manage their cash flow.
So it wouldn't necessarily mean a lower overall dividend. It would just...
change the timing.
Change the timing.
And it could give them some breathing room if their profits are temporarily squeezed.
Okay, makes sense.
Another factor the article mentions is PFLT's ability to raise capital through debt or equity offerings.
Okay, so essentially going out and borrowing more money. Essentially, yeah. Or issuing new shares to bolster their financial position.
But wouldn't that dilute the value
It could.
of existing shares?
It could, but it would also give them more resources to invest, potentially offsetting the dilution in the long run.
Okay.
Of course, it depends on the terms of the offering and how effectively they use the capital they raise.
Right, so there's a lot of ifs.
There's no guaranteed outcome with any investment.
Right.
The Motley Fool is presenting their analysis, their interpretation of the situation, but it's up to each individual investor to decide whether they agree with that assessment.
This has really been fascinating. I feel like we've gone from that initial head-scratcher, like high dividend yield dropping stock price,
Big apparent contradiction,
to a much deeper understanding of PFLT's business, the challenges they're facing, and the potential opportunities they might be able to capitalize on.
And I think the key takeaway here is the importance of going beyond the headlines.
Don't just look at the dividend yield or the stock price in isolation.
Right.
Dig deeper. Understand the company's financials, their strategy, the broader market context.
And most importantly, think about your own
investment goals and risk tolerance.
Right. There's no one size fits all.
Absolutely. Investing is a personal journey.
It is.
And it's about finding opportunities that align with your individual circumstances and financial aspirations.
This has been fantastic, as always.
Glad you enjoyed it.
Thanks for sharing your insights.
My pleasure.
And helping us make sense of this really complex situation.
It's been fun.
It has been. And for everyone listening, remember, keep asking those tough questions.
Keep learning.
Keep learning.
And keep exploring.
The world of investing is full of fascinating challenges and potential rewards.
It certainly is.
Until next time, happy diving.
Happy diving.